16, that is capital structure, and it is related with cost of capital. So we'll discuss today chapter 16 from the Bork and DiMaggio Fundamentals of Corporate Finance. The outline will be this chapter is divided into 7 subsections: capital structure choices, capital structure in profit capital market, debt and taxes, the impact on capital structure, the cost of bankruptcy and financial distress on the capital structure, optimal capital structure, how we find an optimal capital structure. There is a trade-off between the debt and the bankruptcy, the benefit of debt or the tax shield of debt and the financial distress, how we make a trade-off. Additional consequences of leverage, agency cost and information. Capital structure, putting it all together. This chapter you have done in your Fin 501 and other courses. So we will see the modeling part here. Capital structure is the collection of securities a firm issues to raise capital from investors. It can be debt, it can be equity, it can be preferred. Firms consider whether the securities issued will receive a fair price in the market or not. That is very important concern before going for any security to be issued. For example, if it is issued in a wrong time, then it will not get the fair price. It will be issued at a discount, which will be loss for the company. So the issue should be in right time so that it will get the fair price. It should have tax consequences. It should entail transaction cost. So minimum transaction cost should be there. Change future investment opportunity. You should not go for more and more debt so that in future if you go for raising equity or debt, it will be costlier. So you should always keep the future investment opportunity in your kind of plan before going for any issue of securities, whether it is debt or equity. Capital structure across industries, they differ. We calculate the debt to value ratio. Debt to value ratio means debt in the numerator and value of the firm in the denominator. Value of the firm means equity plus debt in the denominator. The debt to value ratio of all the industries in the US in 2015 is being shown here from the source Capital IQ 2015. You can see biotechnology and industry having very minimum debt to value ratio. Maybe there is no debt. There is an average of all firms shown in the average in between. And oil and gas drilling, you can find the debt to value ratio is more than 40%. That means industry to industry, company to company, the debt to value ratio differs. Some companies issue debt more, some companies issue debt less. Why it happens so? What are the consequences? We will see in this chapter. Two examples are provided here. One is Intel Corporation having 15% debt, 85% equity. ARM Holding PLC, it is having 0% debt, 100% equity. In the previous chapter also we have seen Facebook 100% equity. So it depends on company to company and industry to industry, the debt to value ratio differs. So this is being calculated from the source finance and Google open sources. Now we will see the next section, capital structure in a profit capital market. So a profit capital market is a market in which securities are all fair priced. There is no tax consequences or transaction cost. It never happens, but it's an assumption here. Then only you can say it's a perfect capital market. There is no tax. Investment cash flows are independent of financing choices. So the financing choices, investment cash flows, they are independent from each other. Let us take an example. Financing a coffee shop that costs 24,000 to open. Now you have two choices. One is you should do it all equity. The other one is do with equity and debt. If it is all equity, it will be known as an unlevered equity firm or unlevered company. If it is having debt mixed with equity, it will be a levered equity. Whatever the capital structure, whether you have debt, whether you have no debt, the cash flow will be independent, right? As in the perfect capital market, investment cash flows are independent of the financing choices. Whether you have debt, you don't have debt. The cash flows will not have any impact. Cash flow will be independent. Here the cash flow from the coffee shop, you will invest 24,000, you will get back cash flow 34,500 at the end of 1 year. Given the risk, coffee shop should earn 15% return. Then what will be the NPV of the project? Minus 24,000, that is your initial investment, plus 34,500 you will get inflow after 1 year. Cost of capital is 15%, so divided by 1.15 will be equal to 6,000 positive NPV. And it is a unlevered equity, all equity. Now we will have levered equity. Leverage increases the cost of equity. Whenever you increase the leverage, it will increase the cost of equity. So along with leverage, along with debt, cost of equity increases. How? We will see in the example. Choices. Because it is being said here, leverage increases the cost of equity. If you increase leverage, if you don't have leverage, then whatever is the return, that is the return goes to the equity shareholder, 15% goes to the equity shareholder. No leverage. Now, if you want to increase 5% debt, 10% debt, 20% debt, 30% debt, the more and more you increase debt, the cost of equity will go up and up and up. Then you have two choices now. Finance with all equity, only equity. Choice number 2, finance with some equity and some debt. What will happen then? Here, the firm's asset will give independent cash flow of 34,500 end of 1 year. If it is unlevered equity, this 34,500 will be discounted at 1.15, will be equal to 30,000. Initial investment is 24,000, 6,000 goes to the equity shareholder. But if it is issued with debt, say for example 50% equity, 50% debt, then what happens? The debt holder, for example, take 5% interest. 50% of 30,000 is equal to 15,750. Debt holders will take 15,000 their capital plus 5% of 15,000 is equal to 750. Debt holders will take fixed 15,750. Remaining 18,750 goes to whom? To the levered equity holder out of 34,500. 18,750 goes to the equity holder, 15,750 goes to the debt holder. Totally it goes 34,500, which is discounted at 1.15 will equal to 30,000. So end of the day, the value of levered and value of unlevered remains the same. In the value of unlevered also, The end of the day, once you discount, the cash flow was 30,000. Value of unlevered also, after debt holders take their fixed amount, whatever remains that goes to the equity shareholder. Like for example, out of 34,500, 15,750 gone to the debt holder, then remains 18,750, it goes to the equity shareholder. So whether you increase more debt or less debt, end of the day, the debt holders take their fixed amount, remaining amount goes to the equity shareholders. So value of levered equal to the cash flow to the equity holder plus cash flow to the debt holder. This is here from Modigliani and Miller has given their hypothesis. Modigliani and Miller, they with perfect capital market, they have given their hypothesis. What is their hypothesis? In an unlevered farm, cash flows to equity equal the free cash flow from the farm's asset. So anytime unlevered farm, cash flows to the equity holder is the free cash flows from the farm's asset, because there is no debt holder, all equity. So whatever cash flow comes from the asset, that will go to the equity holder. In a levered farm, the same cash flows are divided between debt holder and equity holder. Just you have seen here. The first example is an unlevered farm. All 34,500 goes to the equity shareholders because it is an unlevered equity farm. In the second example, the cash flow is independent. That will be 34,500. That is nothing to do with the capital structure mix. Out of the 34,500, debt holders will take 15,750, that is their contribution plus 5%. Remaining whatever remains, that goes to the equity shareholder. So in a levered farm, same cash flow is divided between debt holder and equity holder as per the agreement. In total, the total to the all investors equals the free cash flow generated by the farm's asset. That's what MM's base assumption is. He says if it is unlevered, all the cash flows go to the equity shareholder. If it is a levered one, the cash flow is independent, 34,500. It goes to the debt holder and equity holder as per their agreement. Debt holder take their fixed amount, remaining whatever that goes to the equity shareholder. In total, it is the 34,500 only. So proposition 1 says value of levered farm is equal to equity plus debt is equal to value of unlevered. So the effect of leverage on risk and return might be different, but end of the day, the value of levered is equal to equity plus debt is equal to value of unlevered. 34,500 is equal to 15,750 plus 18,750 is equal to 34,500. That's proposition 1. Now, to show this, I will stop the recording here.